Markets, there's no stopping them. It's one sector or the other that has been firing up all through January. We've got about 13,500 crore of FII money, and that seems to be the key reason why the markets are cheering up. But what should you be doing as an investor at this point in time? For that crucial question, Sanjay Dutt, director of Quantum Securities, joins us now as our market master for the day. Morning, Sanjay. Markets are in a terribly cheerful mood. You want to play party pooper?
Well, at the outset, what I would like to say is that I have egg on my face, and the viewers should actually mute the channel while I'm speaking right now, because I got it totally wrong. I wasn't expecting it when I last spoke to you, and I was expecting a reasonably good retracement to the 8,000, sub-8,000 range. While accepting that markets always are smarter than us, let me hazard a guess as to what lies ahead. I think markets purely running on momentum, liquidity and expectations right now. The real earnings, the fundamentals need to catch up a lot. But at the same time, as most analysts will tell you, and everyone will tell you, that markets are always factoring in the future. So therefore, it's probably a future what is really built into the prices. If that be so, I think there isn't much scope for the markets to go up in the immediate short term. If I continue to maintain, if there is a possibility, there could be a reasonably good retracement, and that would be a good time to add in to investment buys. Mind you, like I maintain that the medium to long-term outlook of the market is very positive. It's a short-term retracement that I think is long overdue. Even technically, we're a tad overbought. Global factors aren't helping in any manner. So a combination of these should actually pull the markets back before we take the next leg up and come into that 9,400, 9,500 range after we break out of the 9,100, 9,000 range.
But Sanjay, does this period remind you of 2003, when the markets steadily built up? Until 2003, we did not have great numbers in terms of earnings, but thereafter earnings picked up, and we had a nice secular rally all the way up to 2006, 2007. Does it remind you of that period, or does it remind you of a frenzy that we saw only between 2007 and 8, when markets ran on only money? Where is it more akin?
I think it's more akin to the only money and the India story, because on ground things haven't changed as yet, or aren't changing that fast as we want them to. It's only most of us on the Dalal Street or in front of our trading screens are feeling very optimistic. But when you talk to on ground hardcore business people, particularly the real engine of our economy, the real heart of our economy, that's the medium and small enterprise, they're struggling with a lot of problems right now. I think those need to be addressed at the grassroots level, and once that activity picks up, obviously the initiatives that are being taken by the current dispensation, that's Prime Minister and his team, on Make in India and those kind of issues, sorting out bottlenecks, those would lead to that. That's the reason why I maintain that medium term looks good. But I think what we are seeing right now is more akin to the 2007-8 frenzy in the immediate short term. If numbers catch up faster than what we think today, probably this momentum would maintain, and we won't get that pullback that I'm looking at. I'll lose some of my gains and be left behind, but then I'll catch up probably later on, because this is no doubt that there is a secular change, there is a structural change in the way government is looking at business, the way businesses are changing, the way the entire landscape is changing and will change. So that I don't doubt. It's just that this 3-6 months is what we all are trying to comment or game on. At least I'm trying to comment and game on.
Sanjay, hi, good morning. It's very candid of you to accept that you got this market wrong, but you know, it bewilders anyone to see such a sense of entitlement with which this market is moving higher. But be that as it may, we have a slew of paper that will be hitting the market in the near term. In your assessment, generally when there's supply of paper, does it affect the market in a big way, or is it just about a 2 to 3% downtick and then we resume our uptrend?
No, if the downtick does happen, Sonia, it will not be the 2 to 3%. It will probably be bigger than that. And yes, paper supply does impact the market because a lot of liquidity gets sucked in. For instance, in Coal India, approximately $3-4 billion will get sucked in, sucked out, sorry. So therefore, paper supply does move out a lot of money that's meant for equity allocations, particularly out of global emerging market portfolios as well as domestic portfolios. But I think liquidity flows to India would continue as long as the reform momentum and all these measures that are being spoken about are implemented and on ground one sees action. But I think the real stuff we need to see is that the core economy starts to pick up. That's credit offtake, capital goods, employment, numbers. Those take time, but those need to pick up. We haven't seen them picking up in the last 9-12 months, but those need to pick up substantially. Bank balance sheet is getting sorted out. We know government is working on them. We know their right intentions, whether it's power sector or government or bank NPAs, etc. But stuff needs to really radically change there for the entire economy to pick up and the numbers to change. So it's not just about these 100 or 200 or 300 big companies who, drive our economy. It's that real heartland that needs to feel everything kind of, coming back to that robust level.
No, I take your point completely, but let's talk about, how to approach this market sector-wise now, because the good part is that since the start of the year, the rally has been so secular. HUL, Axis, HDFC, L&T, you've cut across all sectors and you've seen gains of 20%. But from here on, what would the sectoral approach be for investors?
I think I continue to maintain what I said, that, financial services banking look good because things like insurance, things like widespread reach of financial services and banking, whether it's mutual fund, NBFCs, those kind of businesses. Then, of course, if you're betting on the economy recovery, then, capital goods, EPC, infra, contracting companies, because that's the only way that you will see a revival in the investment demand, revival in the capex cycle, everything else, and it all flowing down to the grassroots level. So these are the sectors out of big companies that I would look at, which I think would give good returns.
Okay, Sanjay, speaking of financials, the PSU bank numbers that we got from Union and Oriental Bank of Commerce were quite disastrous, especially the bad loan creation. Is this a good time to buy them because you think that this would be perhaps the nadir of the cycle?
Yeah, I think I would take that risk. My bet would be that we've seen the worst of the PSU balance sheet hits, Most PSU banks have been ultra conservative now and trying to provide for everything. So I think negativity as far as, non-performing assets, restructured assets, etc., are all kind of built in, and whatever would happen for the positive as to what RBI is working on and trying to help banks solve the problem relating to these slow recoveries and these bad accounts,
All right. Well, leave it at that, Sanjay Dutt. Thank you very much for joining us and introducing the much-needed note of caution. It is a wall of money, and you can't argue against the ticker. You can't argue against money. You can't argue against liquidity. But we're still, nevertheless, enjoying it. At the moment, a distance away from that magical 9,000 figure, 56 points away. But still within striking distance, you will have to see.